And what I've talked to you about over the past several months is how we are moving into this time where there is this extreme, possibly never seen before, dichotomy that is starting to develop in the housing market, where there is this divergent situation where we have resale homes in major scarcity, and we have new homes coming online, which will be in, not yet, but they will be in a, and I don't want to say in abundance because it's certainly not abundance, but it's better than before. We will have more inventory of new homes than we've had over the past few years, for sure.
And now, here's your host, Jason Hartman, with the complete solution for real estate investors.
If you're watching this on video, comment below on any of this stuff. I always love to hear your thoughts. But if you're listening on the podcast, I am showing a chart that shows the housing starts level from the Federal Reserve Bank of St. Louis from 1977 until now. And it is truly shocking. You know, we had a real downturn in housing starts in about 1981, 1982, as can be expected. We had a major recession, mostly created by our central planners, namely Paul Volcker, who wanted to break the back of inflation with very, very high interest rates. And he did succeed in doing that. But then we had housing starts just skyrocket into about 1983. The housing market was en fuego, on fire, just really, really booming, a lot of housing starts. And then we saw it go down quite a bit in about 1990. As you know, that was the end of the former Soviet Union, bankrupted largely by the Reagan era policies, and things were changing quite a bit. And that was quite a historic time. Obviously, we all know what happened. And then we saw housing starts go up and up and up, and they went up just pretty much on an upward trajectory until the Great Recession. And in 2009, they reached their lowest point ever on this chart, substantially lower than any time since 1977, substantially lower than any time in the 80s, any time on this chart whatsoever, right? And now we saw them kind of come back up, and then it was pretty slow, and until about 2013 or so. And then we saw the housing engine start to create more housing. But it was still, even in 2013, it was still lower than any point on this chart, with a possible exception, because again, I'm reading a chart and it's not exact when you're looking at a chart, with a possible exception of the low point in about 1990. So, by the way, my voice is very hoarse. And so this represents that huge gap in housing supply that has really been going on for many, many years. In fact, one could easily argue that housing starts didn't get to a somewhat normal level until about 2019. Yep, that's what this chart would show us, about 2019 for housing starts. Now, that's not completions, it's just housing starts. And what the chart doesn't tell us, which is incredibly important to consider, what is it not telling us? What dogs aren't barking? Well, it doesn't tell you the price of the homes that were under construction. And as we all know, as we've discussed many times over the past few years, past several years really, on this show, nobody is building entry-level housing. It simply makes zero economic sense for any builder to build an entry-level house. And that's why we have such a good opportunity for rental housing owners, for you investors in that rental housing price range. Now, when we look at the statistics, And we hear, hey, these higher interest rates have left the housing market at a standstill. Things are cooling off. That is true. But the largest weight of that survey is the more expensive homes, because there's hardly any entry level homes even reaching the statistical level where they're even counted. You can't count what's not there, right? You can't hear the dogs that don't bark. And that's exactly what is going on. And that's why so many people are so confused about the housing market and where it's going. Okay, so here is US existing home inventory. And this is from 2000 until now. And we see that inventory is quite literally the lowest ever. Now, again, I can't say that completely because it was actually lower during the COVID era. But statistically speaking, it is extremely, extremely low. Now, remember, this is the National Association of Realtors numbers, counting contingent sales and pending sales, plus all available properties in the MLS. Not the same as I usually share it from the Alto stats that only counts available inventory, which I like better because those are properties people can truly buy. Here is the months of inventory of existing single-family homes for sale. And what I've talked to you about over the past several months is how we are moving into this time where there is this extreme, possibly never seen before, dichotomy that is starting to develop in the housing market, where there is this divergent situation where we have resale homes in major scarcity, and we have new homes coming online, which will be in, not yet, but they will be in a, and I don't want to say in abundance because it's certainly not abundance, but it's better than before. We will have more inventory of new homes than we've had over the past few years, for sure. And that'll be a refreshing change. But again, what is the price point of those new homes? What is the price point? Show me a $300,000 house. Yeah, I know. It's almost like you have to be a magician. I mean, yeah, they're out there. They're few and far between. Virtually none of them are brand new. You just see this giant dichotomy in the market. And it is developing, and it is going to be more and more pronounced as the builders finally start to complete some inventory. Now, unfortunately for the home builders, they're going to complete a lot of this inventory of $500,000, $600,000, $700,000, $800,000 homes, even more expensive homes, in a market where the central planners, the Federal Reserve, Jerome Powell, have massively increased interest rates. And this is obviously hurting their stock. Look at the home builder stocks, and you see what's going on there. Very, very significant issue. But it's not the same market. This is not the entry-level market. This is not the investment property market. This is the broader real estate market of much more expensive homes that investors don't buy. Why would they ever buy them? They have terrible rent to value ratios. So they're definitely not going to buy those. Okay, so 2004, 3.9 months of inventory. 2007, Great Recession time, 9.6 months of inventory. Now, this is existing homes, not new homes. Let's go 10 years forward and go to 2017. 4 months of inventory. Progressively declining. 2018, 3.7 months. 2019, only 3 months of inventory. 2020, 2.1 months of inventory. One of the lowest inventory levels we've seen. And it got even worse in 2021. Now it has ticked up just a tad, but hardly any. It's almost insignificant in terms of historical inventory levels, what we're looking at now. Now, this map divides it up by the states. And you look at the year over year change in existing housing inventory. And I have to tell you that this chart is from, I'm going to say, about 4 months ago. So again, not as pronounced as it is on this chart. Things are a little better than what this chart is, or this map is depicting in terms of inventory. But you can just see what's happened. Inventory has ticked up slightly, right? It has ticked up slightly in the broad historical perspective, but still very, very low historically. Look at Florida, my state. Year over year change in inventory down 58%. Texas down also 58%, 57.7 in Texas, 57.8 in Florida, big deal, close enough. Tennessee down by 63%. North Carolina down by 64%. Arizona, 64% decline in year over year inventory. Utah, 68% decline. I mean, this is shocking. Now, Arizona, because, well, I'll say the Phoenix metro, because that is a cyclical market now, not a hybrid anymore, and definitely not a linear market. Inventory is increasing very rapidly there, very rapidly in California, very rapidly in some of these more expensive cyclical markets. But again, inventory is not inventory. It would be like this. Think of it this way. Say you go in to shop for a car, and you know how car dealerships like to cluster themselves and have a lot of car dealerships together. So you've got a Toyota dealership, a Ford dealership, a Mercedes dealership, and a Porsche dealership, and a BMW dealership. So you got some, lower end cars and some higher end cars, right? And it would be like walking in to the Mercedes dealership or the BMW dealership, the high-end dealership, right? Where the cars are frankly overpriced. They're expensive, right? And you would look around. Now, you're not going to do that today. I'm just giving you a metaphor. But you'd look around their showroom and their parking lot, and you think, wow, they got a reasonable selection of cars here, which they don't because of COVID and the chip shortage. But I'm just giving you an example, okay? So you see that in this example, there is a good amount of inventory of BMWs, Mercedes, and Porsches, right? If you want to spend a lot of money on a car, $70, $80, $90, $100,000, $130,000, there's some good choices of inventory. But then you walk over to the Toyota dealership and the Ford dealership, and they have no inventory. There's hardly any cars there. And you talk to the salesperson, and the salesperson says, yeah, everything we have, you have to order it now, and you have to pay a premium of maybe 10% above the sticker price. You're not going to negotiate down. You're going to pay above the sticker price to buy a car and order it and wait 8 months to get your car. That's the difference in the housing market. The inventory level of $700,000 homes and $600,000 homes and $800-900 million plus homes is dramatically different than the inventory levels of starter homes, of entry-level homes that make good rental properties, the kinds of properties you'll find at jasonhartman.com in the properties page. A completely different picture. All right. Here, just to remind you of what we covered last week, is the Altos inventory stats, right? 577,000 homes for sale. And that represented a 1% uptick from a week earlier, which is actually quite significant. And what I did for you last week is I gave you a scenario. I said, what if inventory goes up by 52%? Now, I know it's not compounding, which would be the more mathematically maybe pure way to do it, right? But just say it increases by 52%, 1% per week for a year. That would add 300,000 homes to the market, but we would still be short by about 320,000 homes. in terms of normal inventory levels. Folks, if you're listening to this show, you get it. You understand the real dynamics of the market, not the BS, not the clickbait, not the, fear mongering that's out there. And listen, I am by no means saying the economy is in good shape. It's not. I mean, we are going into a recession if we're not in one already. But if you're expecting a huge housing crash in the entry-level housing market, don't hold your breath. Do not hold your breath. Okay, collective members. If you're a member of our collective mastermind group, we have changed the time and day for my monthly Zoom meetings. It is now the third Thursday of every month will be my meeting. George Gammon has a different meeting. Ken McElroy has a different meeting. They do monthly meetings as well for our collective mastermind group, but I just wanted to tell you that has changed if you are a collective member and you're listening. So I'll see you Thursday on Zoom. Now, one more thing before we get to Dr. Mark Faber, legendary investor. Doom, gloom, and boom. Okay, and mostly gloom. Here's some demographic information. And, we talk a lot about demographics on this show over many, many years, but we haven't talked much about it lately, right? Not lately. And the demographics are what tell you who will be buying and renting houses over the coming years. And what we see here is we see the birth rate for the underlying each generation, each demographic cohort. So we've got the silent generation, the baby boomers, 76 million people, Gen X, my generation. Now they say 55 million. I've said 46 million. My generation's kind of a small, lonely generation. Then the millennials, and by the way, their numbers are off. Demographers, by the way, never agree on this stuff. The millennial generation, I have said, is about 80 million people, slightly larger than the baby boomers. Their number's different. Demographers disagree on this stuff, but mostly those are the numbers, the ones I've told you about. And then the post-millennials are the Zoomers, right? They're 61 million people, okay? Now, the millennials, a whole bunch of them are 33 years old today. They're 33 years old, okay? My generation, the Gen Xers, a big part of that generation was 33 years old in 2006. Just think about the household formation level. And what I've told you many, many times is, remember, about 11 years ago, I made the prediction, 2010, that the next 10 years, the demographics coming at the rental housing market are nothing short of phenomenal. And then I renewed that prediction for another 10 years. And I said to you, the next 10 years, from 2020 to 2030, of demographics coming at the rental housing market are nothing short of phenomenal. They are phenomenal. Don't miss it. Do not miss it. Okay. Don't forget to get your tickets to Empowered Investor Live. By the way, I'm going to give you the direct link for the ticket website there. It's empoweredinvestor.com/live. So you're not distracted and confused by going to jasonhartman.com, although you can go there. But just go to empoweredinvestor.com/live and get your tickets for Empowered Investor Live. It's going to be a great event in beautiful Scottsdale, Arizona, last weekend of January. We can't wait to see you there.